Will their actions impact your portfolio? SoFi head of investment strategy, Liz Young, joins us now. Liz, always good to get some time with you here. Look, a lot of folks on the street are starting to get worried about a recession here. You have red hot inflation. You have the Fed getting ready to drop the hammer on rate hikes. Where do you stand?
Well, it does feel like it's going to be really difficult for the Fed to stick the landing over the next few months on this. But today's news is likely to be 25 basis points. We'll let the horse out of the barn, right? We'll have liftoff on rates, and then we're going to wait to see what the signals are on other tools that they have. So importantly, we're going to probably hear something about what they intend to do with the balance sheet runoff. I don't know that we're going to get something all that specific, but we might hear something along the lines of the balance sheet runoff will need to be more aggressive than it was last time, which the market may start to interpret as the idea that they will engage in outright sales at some point. Now, what Brian mentioned earlier about what we would call the terminal rate being about 2.5%, most Fed governors at this point are expecting about a 2.5% terminal rate. That doesn't mean we're going to get to that 2.5% in a straight line. And I really don't think we can get to that in a straight line, especially with the yield curve as flat as it is. So I think the market at this point right now has overestimated what the Fed can do in the first handful of hikes. And I think we're going to have to pull back those expectations.
And Liz, great to see you. I know that you're laser focused on the yield curve, specifically looking at the spread between the 2-year yield and the 10-year yield, which is now about 30 basis points, had been as low as 20 basis points. And we know that when that gets to negative territory, that is the short-term rate is greater than the long-term rate, well, that's a recession indicator. What are you seeing in it right now?
Well, I think there are a couple people that are excited that we've widened out to 30 basis points. 30 basis points is hardly wide. And this is still pretty narrow. This is a fragile place for the yield curve to be heading into a hiking cycle. Also remember the VIX, which is that measure of volatility on the equity indices, is still pretty elevated around 30. So this is really a different time for the Fed to have to do something like this. Now, when we look at a yield curve inversion, it's really important to think about what that actually means. So you might see an inversion at some point that happens intraday, where the yield curve inverts just a whisker over that zero line, but it doesn't close inverted. That doesn't count as a signal. In order for it to count as a signal, and this is my personal opinion, this is not a scientific opinion, but in order for it to count as a signal, it needs to last for a decent amount of time, and I would call that about a month at least. And it would have to invert by a decent amount of basis points. Can't just be 1 basis point here or there, let's say 25 basis points. So even if it inverts for a couple days by a very shallow amount, that doesn't necessarily count as a recession indicator.
Liz, to your point earlier, the horse is about to be let out of the barn on rates. What will that mean for consumer spending? We had a weak read this morning on retail sales. Is that a sign of things to come?
Well, if you break down that retail sales number actually and take out used cars and gasoline, it's down even more. So the retail sales number is actually even weaker than it looked on the surface. I do think that consumers have been affected, at least in the short term, on expectations on inflation. And we're seeing that in consumer confidence numbers. We've seen those take a bit of a nosedive in recent months as well, mostly based on the fear of inflation. So it's still yet to be seen if Fed moves can do anything about inflation, at least in the short term. And you have to remember, rate hikes really just affect the demand side of the economy. The Fed can't do anything about supply. So right now, it's that demand is so outstripping supply that inflation is in the system. As the Fed raises rates, the hope is that demand starts to relax, supply also increases, completely unrelated to raising rates, and then we get a little bit more equilibrium and inflation comes down. But the timing of that is still a big question mark. Also remember, we have this Fed meeting today, and then there's a long period of time between today and the May meeting where we hear from them again and might get the second hike.
And Liz, we're talking about all these macro topics. How does this fit into your investment thesis? Where are you seeing stocks, major indices, going over the next, let's say, into the end of the year? And what kind of sector action are you looking for?
Well, I think there's probably a lot of people out there that would love to hear me say something like technology is going to come back and it's going to beat, and I think it's going to be great for the rest of the year. Although I do think that some of the stress will come out of the tech sector and will come out of the NASDAQ. I still don't think that this is a year where technology ends up being the standout performer. Now, we talk about it a lot as it being the largest sector in the S&P, so the S&P is going to be a little bit pressured as long as technology is pressured, and that's probably true. So what we would like to see is for technology to stabilize, and the chances of that are decent at this point in time, at least as we look forward about 6 to 12 months. And the reason is because as you head into a rate hike cycle, you usually see cyclical sectors outperform. And then once you get past that first hike and get into the cycle, you see things like technology, consumer discretionary, communications stabilize more. Also, I think there's just this relief that we're finally getting this first statement over with and we can get through it. And then think about where we are on the NASDAQ. We're in bear market territory on the NASDAQ. It was down 20% since its all-time high. Absent a recession, that's a pretty good flush in an index. So I think it's enough for now. And then we look forward to, possible language out of the Fed that we won't get 6 or 7 hikes. And if there is some sort of dovish pivot that happens, maybe we're only expecting 4 to 5 hikes, then you see a little bit more support for those growthy sectors as well.
Always appreciate you keeping it real for us. SoFi Head of Investment Strategy, Liz Young, good to see you. Enjoy Fed Day.